Hi everyone. In this lecture, our objective is to learn how to apply the CAPM model to value corporations through their free cash flow, or in other words, capital budgeting. So today's agenda is the following. We will first discuss the motivations for using CAPM and kind of backtrack a little bit so that we understand where we are in terms of our valuation objective. Second, we'll talk about the components of constructing a overall discount rate for the firm, and that requires us to decompose our discount rate into essentially two parts: our cost of capital for debt and our cost of capital for equity. And lastly, we will talk about constructing a cost of capital through comparables. So in many cases, we aren't able to value a company according to their, for example, segment or specific project, and that may require us to kind of find firms that are comparable to a specific sector or industry that a firm is operating in to construct a cost of capital for that division, for example. In addition, you may think about firms that aren't publicly traded, and in that case, we can't construct a discount rate for the firm, and therefore requires us to find comparables and then follow our methodology to construct the cost of capital for debt and equity, and then find some weighted average to use as a discount rate. All right, in any case, let us first talk about the motivation, kind of backtrack a bit where we've been learning for the past few weeks. So what we have done so far in the class is to discuss how to project free cash flow. That requires us, of course, to decompose free cash flow into several components, namely its earnings before interest and taxes, and then talking about capital expenditures, change in net working capital, and so forth. And we also talked about using a discount rate to value dividends as well, right? Especially for a firm that's all equity, right? Meaning that they don't have any debt holders, but everyone is basically a equity shareholder. And as I already stated, we discount these free cash flows or dividend payments using the opportunity cost of capital. And the question we have been asking ourselves for the past several weeks is, where does this opportunity cost of capital come from? And based on what we've talked about so far in the past few weeks, we basically have all the components we have to do this. First, we talked about debt, right? We presumed that debt, in other words, basically are some variation or some function of the risk-free rate. And so once we have the risk-free rate and we kind of know how likely a firm is going to default, we can definitely come up with a cost of debt for the firm. And last week we talked about the CAPM model, right? The CAPM model is supposed to give us a model to kind of value the equity side of the firm. And so the idea, the overall message from last week and also all lectures up to today is that the opportunity cost of capital should reflect the return of the securities that we issued, right? And so there are basically two parts to a company, as you all know: the debt side and the debt holder side, and also the equity shareholder side. So let me reiterate what the opportunity cost of capital should come from. It should come from the investor's expectation about its return on the securities that it issued. So I'm going to write expected return of the securities the firm issues. Of course, the firm doesn't issue, in most cases, securities that are partially debt and partially equity, right? In most cases, they issue two types. One is a equity type or shareholder type, in which you share the revenue above and beyond what covers your operations, and they also issue a debt contract, which is a fixed return, but you get first dibs in the case of bankruptcy, right? You get control rights when the firm decides to liquidate or go bankrupt. You get paid first. But in any case, that's the idea. We want to come up with an expected return on the firm based on the securities that's issued, and we can definitely value this, come up with this return using the models we have at hand, right? We have a way to value debt, and we also have a way to value risky assets through the CAPM model. So I'm going to write use CAPM model to value them. Okay, so to reiterate, you don't have to use, definitely because CAPM can be generalized for all securities, you don't have to use bond valuation to value risky debt, for example, or debt that's being issued by the corporation. CAPM definitely can be used to value debt contracts as well. Debt contracts has returns. It has prices, and therefore, if it has prices and there's a time series of prices, we can calculate its exposure to that single risk factor, and therefore come up with a return or cost of capital of debt. Okay, so to summarize, the key idea of today is we want to basically find a proper opportunity cost or required rate of return to match the riskiness of the cash flow coming out from the firm. So that's the overarching idea. We want to find a proper discount rate or opportunity cost or in other words, or alternatively said, required rate of return to match with riskiness of cash flow. Okay, so that's kind of the key idea here. We want to come up with a measure of riskiness so that it's intimately linked with its cash flow, right? The riskiness of the cash flow. So we want to match return with cash flow, and this link is going to be some measure of its riskiness. All right, so keep that in mind as we continue on with today's explanation of constructing the discount rate for the firm. All right, so let's talk about the components that go into constructing the discount rate for the firm. So as I already stated already, in the case in which the firm is purely owned by equity shareholders, there is no debt, and therefore the only cost of capital that's relevant is the equity cost of capital. And as we know from last week, an all-equity firm can be valued based on the capital asset pricing model, or the CAPM. And the CAPM can be represented in the following way, as pointed out in number 2. We can obtain the cost of capital for equity by taking the market risk premium. That's this term here. So let me write market risk premium, multiplying it by beta, which is our measure of a firm's cash flows exposure to the market risk premium, and then adding the risk-free rate. And that will give us the cost of capital of equity for the particular firm. So the question posed in the end of this slide asks, when is RE equal to the opportunity cost of capital? They are the same when there is no debt financing. In other words, all equity firm. Okay, so that makes life easier if your firm is all equity. Of course, that's never the case in reality. All firms most likely have some form of debt, and there's many reasons why a firm may want to do that, and we'll talk about that later on. Okay, but we first acknowledge reality. Firms have two sources of financing. First, as already stated, the firm is financed through common stock issuances, usually through IPOs, sometimes through seasoned equity offerings. But in any case, that just means that after servicing debt, the remaining profits go to these stakeholders. Alternatively, firms can also finance their projects through bank loans. So if a firm wants to pursue a new project, rather than issuing new shares, which may dilute profit-sharing returns, they alternatively can issue debt, usually through bank loans or through issuing debt in the the primary debt markets. And these contracts have fixed returns as opposed to floating returns, which is a function of earnings growth, and therefore different risk exposure. So in the case in which we only consider two types of financing sources, we implicitly assume that a firm's capital structure or balance sheet looks like the following. And the liability side, there's only two stakeholders. We have the debt contract holders and the equity or shareholders. And the asset is whatever the firm has at hand, right? Whatever all the assets, all the intellectual properties, all the factories, all the office supplies, whatever. It's all in the asset side, okay? So in the case in which we have no taxes, we can come up a very simple generalization for the cost of capital for the firm. So that's what I have written here. If we take RU, where U indicates the, let's call it the unlevered cost of capital. That's what the U stands for. So unlevered here means not net of tax liabilities. Sometimes the RU is also termed as the pre-tax, WACC, and remind you that WACC stands for the weighted average cost of capital. So RU then is simply a weighted average based on the capital structure of the firm, meaning its leverage ratio essentially, of the cost of equity and the cost of debt. And the cost of equity is represented by RE, and the cost of debt is represented by RD. And our capital structure is then simply the ratio between the equity amount versus the total value of the firm, which is just D plus E. So sometimes I will write D plus E set equal to V. Okay, so V stands for the total value of the firm, whereas D and E stands for total debt outstanding, and the E stands for market capitalization. So as you can see, D over D plus E designate our leverage ratio, right? The amount of debt a firm takes on divided by the total firm value, and that's being weighted on the cost of debt capital. Okay, and then whatever remaining portion of the firm is then weighting the cost of equity. So in this capital structure, so based on this discount rate, I want to emphasize that this discount rate does not account for tax shields, right? Because we didn't multiply our cost of debt by 1 minus tau, as I showed you in the previous homework assignment, or ungraded homework assignment. So it's worth noting that in this pre-tax WACC, we are not incorporating the tax shields into the discount rate. So that's why it's called unlevered cost of capital, because we have not adjusted our discount rate for tax liabilities or positive liabilities. So tax shields not included. So it's worth noting that if you decide to use this discount rate for all periods of cash flow, you're essentially assuming the firm's capital structure as represented by this debt to firm value ratio as being constant. Okay, so if you take more advanced classes into the future, you'll see that under certain models you may have to have a different capital structure each period. In that case, you would have to model how the debt structure evolves over time, and that requires you to figure out how much interest payments you would be servicing every period as well. But that's kind of beyond this course. So in any case, for this class, you can safely assume that the capital structure of the firm stays constant throughout its lifetime. So yes, so let me emphasize the term here. Capital structure is indicating how firm is financed, and it's represented by the debt to firm value ratio, or even just debt to equity ratio. Okay, you get the same assumption results. All right, so let's now look at the case in which we do have taxes. In which case we do have taxes, and the government does provide some tax rebate from taking on leverage. Then we can readjust our WACC, pre-tax WACC, to the post-tax WACC, or after-tax WACC. So let me indicate here. This is also sometimes called the after-tax WACC. So the after-tax WACC just means we are now incorporating tax shields into our discount rate. And we can do this by, as shown in this equation here, by multiplying our cost of debt, RD, times 1 minus the tax rate, okay, as shown here. So if you do multiply this expression out, you'll see that we get the following formula here, right? Because RD times 1 minus RD times tau D, and then distribute the debt ratio, D over D plus E, you'll get this following expression here. So again, RU stands for the pre-tax WACC, or the unlevered cost of capital, and then we get a minus sign times the debt ratio times tau D times the cost of debt, okay? And the minus sign indicates that the cost of debt, or the cost of capital, is lower, meaning that because of the tax shield, the riskiness of the cash flows is essentially lower. So let me write that down. The minus sign indicates a lower cost of capital, assuming that the government provides to some degree of rebate on taxes. Okay, so to remind you what tax shields mean again, let me write it here. So tax shields. Tax shields means that interest on debt that is tax deductible. So that means that we don't have to incorporate the interest that we should pay on our debt to service the debt when calculating our overall tax that we pay to the government. In other words, we can subtract interest payments from EBIT before calculating taxes. So I will show you that incorporating the tax shield directly into the discount rate is going to yield the same valuation if we incorporated the tax shields directly in the cash flow in a second here. So let me first go over an example first to give you an idea how these calculations are done. And then I'm going to prove to you that whether you incorporate the tax shields into the discount rate like we do here, is going to give us the same valuation for the firm if we incorporated the tax shields directly into the cash flow. That means we just simply pay ourselves back for netting out the deductions, right? So, all right, so let's do that example first, and then I'll prove to you that whether or not you incorporate one way or the other, it doesn't matter, firm value remains the same. Okay, so in the first example, let's assume that we have a company named Quicksilver. Let's call that ZQK. And they have a market cap of $250 million. So that means the equity side of the firm is valued at $250 million and $800 million of debt outstanding. So you can think of the debt being valued at $800 million. So let's write our assumptions down here using some variables. So we're assuming that E is equal to 250 millions. And the debt of Quicksilver is 800 million. Next, we also assume that the cost of equity capital is 10% and the cost of debt capital is 10%. So using the same variables we defined earlier, RE is equal to then 10% and our debt is equal to 6%. So I presume that these are all per annum. So let's just assume they are per annum. What is Quicksilver's unlevered cost of capital? And if its corporate tax rate is 40%, what is its after-tax WACC? So let me write after tax just to emphasize that we're considering into our tax shields. All right, so based on the equations above, our unlevered cost of capital, or our pre-tax WACC, looks like the following. It's simply a weighted average between the cost of debt and the cost of equity. And we simply have to calculate the ratio between the debt to the total value of the firm. So just to reiterate again, the total value of the firm can be computed by adding the debt value of the firm plus the equity value of the firm. And in this case, our total value of the firm is $1,050 million. Okay, so in that case, we can simply calculate the pre-tax WACC by taking the ratio of equity. That's 250 over 1050, multiplying by 10%, adding it to the debt ratio, which is 800 to 1050 times 6%, and that's going to give us roughly 7%. In order to get the after-tax WACC, we subtract the debt tax shelter as discussed above. That equation looks like the following. So I'm just going to write WR WACC to indicate that it's after-tax WACC, which is equal to RU minus the debt ratio. So let me write that here again, times tau D times RD, and that's just equal to 7% minus 800 divided by 1050 multiplied by 6% multiplied by 40%, and that's going to give us 5.3%. So the message here is, after accounting for the tax shelter or the tax shields, our discount rate declines from 7% to 5.3%. And the reason is because the firm is now essentially less risky because of additional cash flow, right? All right, so our next step is I'm going to try to show you that whether or not you incorporate the tax shields directly into the discount rate or into the cash flow equation, it doesn't matter. It's going to yield the same value for the firm, and actually the algebra is quite simple. So let me set up the problem first, and then once I go through step by step the derivation, it should be clear that if you define the cash flow to incorporate the tax shields and use the so-called pre-tax WACC, you're going to get the same value for the firm if you use our original free cash flow equation and discount it using the after-tax WACC. So let me skip to the appendix to do the derivation stuff. All right, so let's do this by hand. So the setup of the problem, we're going to use the same variables, but we're just going to note, I'm just going to emphasize some expressions using some English words, okay, so that things become clearer when I do the derivation. So as you know, RD is going to represent our cost of capital of debt, and therefore our interest payments, our total interest payments, is simply the debt level multiplied by our cost of debt. So when you see RD times D, just know that we're talking about the total interest payment that's being serviced by the firm. So interest payments. Okay, and how much does the firm pay in taxes? If there is a tax rebate, that can be calculated by subtracting out the interest payments from the total amount of, from the EBIT of the firm. So I'm going to use X to designate EBIT here, just to make the notation simpler. And if there is a tax rebate by the firm, or a tax deduction by the state or the government, we simply subtract X. We subtract from X RDD, right? That's the total interest payments that you would use to service the debt. We net it out from EBIT, and then that amount is what's going to be taxed. So I'm going to write tau here to indicate the tax rate, and use some description to explain what this is. This is how much a firm pays in taxes, right? It's the tax rate times its EBIT, and if there's any sort of deductions that's allowed, we subtract that out, so the firm pays less in taxes if there is such a rebate imposed by the government or allowed by the government. All right, so therefore our post-tax income in this new, if we decide to account for these tax deductions directly into our cash flow definition, would look like the following. So our post-tax income, if we choose to incorporate tax deductions in our definition of free cash flow, would look like the following. It would be X minus this expression here. So that would be X minus RDD times tau. Okay, so to emphasize, this is EBIT, and this is tax deduction. And this entire expression here is tax owed. Okay, so we're simply just taking our total earnings before income and taxes and netting out what we owe to the government. And remember, EBIT is a flow variable, so each period we do this. Okay, so we're just, for the sake of simplicity, we're assuming that each period's EBIT is the same, and therefore we're netting out the same level of taxes each period as well. Let's assume that our period goes to infinity, as we assume typically that the firm is infinitely lived. So let's work out the algebra so that we get an expression that looks familiar to us. So taking X minus RD times D times tau, we can multiply tau through. So that's X minus X tau plus tau RD times D. And let's group things together. So let's factor out X. So that's 1 minus tau plus tau RDD. So this expression here is our after-tax EBIT, which you've seen before many times. And this plus tau RD is our so-called tax shield. Okay, so now the question here is, does discounting this cash flow that appears every period into infinity going to yield the same present value if we value the free cash flow definition of what we talked about for the first few weeks of this course, and discounting that using our after-tax WACC? And our goal here is to show that they're the same, and we can do that quite easily. And so I'm going to do that now. So let's call this new cash flow the capital cash flow, okay, which is what's typically used in the literature. So capital cash flow just means we adjusted the free cash flow for tax shield directly. And now our claim is that the value of the firm as represented by capital cash flow is going to be equal to the present value of this capital cash flow when discounting using the pre-tax WACC. So let's use our capital cash flow expression here. That means we have tax shields. And we're going to discount this using the pre-tax WACC. So that's R D over V. So remember, V is D plus E plus R E over V, right? And remember, we don't see any 1 minus tau in the denominator. So our expression looks like this because we're assuming the cash flow is constant every period. And also for simplification, we're not including CAPEX or net working capital. Okay, so we're just simply looking at EBIT plus any tax shields and assuming this amount is the same forever. So this should look like our C over R, right? Where our R was our discount rate of an infinite period of cash flow, right? C. Okay, and we're going to compare this VCCV with our value of the firm, assuming we are using the free cash flow definition. So recall, in the free cash flow definition, we're not using, there's no tax shields component, so it's just simply EBIT. So let's just use EBIT times 1 minus tau, right? No CAPEX, we're just assuming that's 0 for now for simplicity. And we're going to use the post-tax WACC. That's RD times 1 minus tau, D over V, plus RE over V. Okay? So the difference here is this term here for free cash flow of the value using for the value of the firm, and for VCCV, the difference is in the numerator. Okay? And so I'm going to try to explain to you that these two valuations are the same, and that's quite easy. If we start from this equation here, what we can do is first multiply both sides by the denominator. So once we do that, we should get V. So remember, this V and this V are the same. So I'm just going to drop the V's here. So V times RD 1 minus tau D over V plus V times RE and E over V. And that's going to equal to X1 minus tau. Okay. Let's multiply it all out. So we can get the following expression. VRD 1 minus tau D over V. Sorry. What I mean is VRD D over V minus VRD D over V tau plus VRE E over V equal to X1 minus tau. And then we realize that the V's cancel out here. Oh, sorry, not that V. Let's just keep the V here, but realize that the V's cancel out here. And we can move this term to the right-hand side. And then we can factor out the V's here. So then we have V times RD D over V plus RE E over V. And then moving that RD times D times tau to the right-hand side, we get X1 minus tau plus RD D tau. And note that the right-hand side expression already looks like the numerator of the VCCV valuation of the firm. all that's left is we have to divide both sides by now what seems to be the pre-tax WACC. And then once we move this RD times D over V plus RE times E over V on both sides, we arrive at this VCCV expression. So in other words, we have shown that VCCF is equal to VFCF, right? So just remember, I skipped this step here. You have to divide both sides by the pre-tax WACC here to move from the value of the firm using the free cash flow to equate to the value of the firm using the capital cash flow. All right, so what I've shown to you here is basically that what we've done so far in this class is assume we can capture these cash flows by simply incorporating the tax shield directly into the discount rate. We don't have to worry about subtracting out the interest payments that we don't have to pay tax on in the cash flow statement. So our free cash flow expression, therefore, is simpler and easier to derive. All right, so let's go back to slide 8 here. All right, so let's move on. All right, so in general, there's two ways to calculate the WACC in practice, and I'm going to go over two of them here. So first things first, in both ways, we have to find some way to calculate the betas of the different asset class. So let me talk about the first way. The first way is different from the second way in the sense that we don't compute an overall beta to represent the firm. We actually keep the beta separate to calculate the discount rate, and then we combine the discount rates to come up with an overall discount rate for the firm. The second way is different because we actually combine the betas first and then use that single beta to come up with a discount rate for the overall firm. So let's talk about the first way. The first way is sequence of way of computing this is the following. We first compute the betas for each asset class. So beta E represents the beta for the cost of capital of equity, and the beta D represents the cost of debt for the firm, issued by the firm. In both cases, you would rely on the CAPM model, but you would need prices in order to derive returns and therefore use the CAPM formula to come up with a cost of capital. All right. From these betas, our next step based on method 1 is to compute the costs of capital using CAPM, and that's RE and RD. And then we combine these discount rates using the weighted average cost of capital formula. So we can get RU, or the unlevered cost of capital, and then account for tax shields to compute our WACC. For the second way, fairly similar, but instead of keeping the cost of capital separate, we combine the betas into a single beta to represent the firm. In other words, same thing, we first have to compute beta E and beta D, but then we use the capital structure weights to compute a overall beta for the firm, and that's called the unlevered beta or the asset beta. It's called unlevered or asset beta because the beta is not net of liabilities. It actually includes both risk from two different types of securities. Once we have the unlevered beta or the asset beta, we can then use the CAPM model to come up with an overall discount rate. That's going to be RU, right? The unlevered cost of capital. And then go from there, we can calculate our WACC by incorporating tax shields. Okay, the way we combine the betas in the second method is by, again, using the capital structure of the firm that we observe. So that's this expression here. So this expression has a name in the literature. It's called the Harris-Pringle equation. In case you were curious. All right, and also let me give you the names of beta U, and of course from textbook to textbook they may use different names. So beta U is sometimes called the asset beta, or more directly the unlevered beta. And remember, unlevered here means not net of liabilities. So in other words, this beta represents the entirety of the firm, whereas beta E is going to be levered because the beta is calculated from prices of securities that have already been net of liabilities. Okay, so I'm going to write levered beta here because it reflects debt borrowing already. So once we have our asset beta, we can go ahead and compute the cost of capital as indicated by this expression here. So we move this beta here to here, use the CAPM formula to come up with the overall unlevered cost of capital, and then once we account for tax shields, we get our discount rate, right, or our WACC. In general, it should be quite obvious that beta, the asset beta, is less than beta E, right? Because the cost of debt is typically lower than the beta of the cost of equity. All right, so now we have an idea of how we can empirically compute the cost of capital of the entire firm. What you should be wondering is, okay, how do we go about calculating each of these components? And you should realize that first, not all firms obviously are publicly traded, and therefore cost of equity is going to be difficult to calculate. That's fine. But let's assume that we are, and so we can take care of that later. What you should notice is that more importantly is that not all firms have publicly traded debt. And if that's the case, we can't derive beta D. And that is a challenge for us financial practitioners, corporate finance practitioners. And so what we have to typically rely is on credit spreads, which is provided by most credit agencies. So credit spread is basically some premium that you have to attach to the risk-free rate to get an overall rate of return for the cost of debt of the firm. So that spread can be calculated is usually provided by credit agencies. So this is given. Let me make that clear. This is given by credit agencies. And now I'll give you an example in a few slides. And once we have this spread, we can simply tack it on to the risk-free rate and to get an implied cost of debt for the firm. Okay. So in most cases, we don't observe, not all firms have publicly traded debt. And if that's the case, we can't calculate the debt beta directly. And one way to overcome this is to go straight to the cost of debt by simply looking at credit spreads and tacking on that additional premium you would need on top of the risk-free rate to get a cost of capital for debt for that firm. All right, so let's look at the next slide, which gives us a table that that's basically a cross-section of ratings provided by the top 3 rating agencies and what that means for investors in terms of risk. So as you can see, there's 3 rating agencies provided to you. There's Moody's, there's S&P, and there's Fitch. And this is what investment grade means. Investment grade means that they have anything above this line here, right? So let me draw a line here to indicate where investment grade. So if you are a pension fund, if you are a mutual fund, you typically would invest if you're required to hold on to some corporate debt, you typically would put your money in these investment grade bonds. Junk bonds is everything that's essentially speculative. So let me give you some firms to give you a sense of how risky these firms are. So if you think about, one of the largest market cap firms out there today is Apple, and Apple has a rating of AA+ or Moody's AA1. So this is where Apple is. At the time of looking at this firm, the price, the bond yield they have is around 3.52% for a 10-year bond, and the 10-year treasury yield is roughly 3.2%. So you can see that Apple's debt is almost very, very close to the risk-free rate, essentially. Okay, so this is per annum. If we look at something a little bit more risky compared to Apple, we have Tencent. Tencent will, at the time of looking, for me, Tencent has an A+ investment grade credit rating, and their bond yield is around 4%. So as you can see, riskier asset requires higher returns. And let's look at a more controversial firm that has much, much riskier cash flow. I was looking at a firm called Tesla. So Tesla has a B- for S&P credit rating, and at the time of looking, I saw Tesla having a bond yield of roughly 8.9%. So almost triple, right? Or more than triple of the risk-free rate. All right, so give you an idea of the relationship between riskiness and bond ratings, and these credit agencies typically assign a spread, that means a number that's added on top of the risk-free rate, to capture this additional riskiness associated to the cash flow of the firm. So if you look on the next slide, we have a table that's provided by Bonds Online. You can Google this, definitely, and they have a table that's continuously updated. So what this table tells you is that once you know the rating score of the firm you're trying to value and you don't observe its debt, you can simply use these ratings and find its corresponding credit spread. So for example, in this table, for a AAA corporate bond, that's this row here, if we want to look at its 5-year credit premium, that would be 18. So that's 18 basis points on top of the risk-free rate. So if the risk-free rate is 1.74%, then the cost of debt for this firm that's AAA rated, if we decide to use the 5-year bond, it's going to be 18 basis points on top of 1.7%. So let me remind you what basis points means. One basis point is equal to 0.01%. Okay, so that's 1.74 plus 0.18, and that's going to give us 1.92%. So for 5 years, remember this is per annum. You can go ahead and use 5 years if you want, but for most practitioners, we typically try to use a longer term maturity as possible, because again, if we're assuming the firm is infinitely lived and also its capital structure isn't changing over time, then we try to use a cost of debt that's going to be at its longest horizon, that represents, the firm in its long term. So remember, these basis point spreads are in per annum terms, and of course, using these shorter maturities is fine if you think that, for example, you think the firm is going to be sold within 5 years, then maybe 5 years is fine. But if you're assuming the firm is going to be close to infinitely lived, maybe it will still exist within 30 years, then the recommendation is to use spreads with the longest maturity. Okay. All right. So there isn't a sample exercise of computing the cost of capital for Home Depot, so I'll let you look over that yourself. I will go over this in the Zoom session in a few days. All right, so the final topic is going to be about cost of capital and comp. So in the case in which you can't derive the cost of equity or the cost of debt for a firm, then we have to rely on substitutes, right? Firms that look like and behave like the firm you want to value eventually, and we're going to use those other firms to derive a composite beta for both debt and equity. This is particularly important if you're trying to value a privately held firm, for example, or a segment of a particular firm. You can imagine that there's several companies that are basically conglomerates with several types of divisions that are unrelated to each other. Using the single cost of debt to represent the firm to value that particular segment is not wise. The reason is because, as stated, we kind of want the reason for using a discount rate in the first place that's unique to the firm is because we want to capture its riskiness of the firm. But if we're only talking about one single division, we have to somehow match that riskiness of that division to the proper discount rate. And using the overall firm discount rate is not theoretically sound, right? It's not properly, we're not matching the risk properly to the right discount rate. So let's dive a little bit deeper into this feature of using the WACC formula. Okay, so far we have outlined a procedure to calculate the cost of capital. We find the equity beta using CAPM. For the debt beta, if we can't find debt prices of their corporate bonds being traded, we rely on debt rating, and therefore using the spread allow us to calculate the cost of debt. And then we combine these cost of capital together to get a unlevered cost of capital, and that allows us to discount the cash flow of the overall firm. But there's a problem for this approach, is because we need data of the firm to actually compute these components of the WACC. So the problem, as I just stated, we need data. Okay, so first approach we can overcome this issue is by using comparable firms to estimate the cost of capital. So that means we find a set of firms. Ideally, they're publicly traded with risks that are similar to the project or firm we're trying to value. And for each firm, we conduct what we just went over a few slides ago. We have to compute the equity beta. We have to compute the debt beta. And then for each firm, given these equity and debt beta, we can come up with the unlevered beta. And then we take the average, right? Simple average is good enough for us. So once we have this average beta that's supposed to represent our firm, we can go ahead and use the CAPM to come up with the proper discount rate, right? So we use this beta, the asset beta, to get the unlevered cost of capital, and then we adjust for our tax shields to get the WACC. All right, so once we get this beta, we can definitely match this with credit spreads as well. And if we know the investment grade, we can come up with the credit spread. Okay, again, visit the website that I was just mentioned before to get those credit spreads. And of course, we can combine and take an average of these credit spreads based on the beta. And also, we can obviously also collapse based on the maturity if that's important to us. Again, it may also depend on the lifetime of the project or division that we're thinking about selling eventually. Okay, so let's go over an example. So let's take a look at industry average of unlevered beta. So based on these two companies, we have Dillard's and Sears. So for those of you who are not familiar with Dillard's and Sears, they are both large retail companies that sell basically everything from clothing to groceries to machines, like workout stuff. Okay, so they sell consumer goods essentially. If you notice, one thing is that despite being in the same industry, they have widely different equity betas, right? And that seems to be correlated with their capital structure. So remember, D over V stands for debt to firm value. Their debt beta looks quite similar. And what we notice is that their unlevered beta, however, seems very close. So this final column makes the most sense. Unlevered beta makes sense because Dillard's and Sears operate within the same industry, so averaging the unlevered beta makes sense. It would be a mistake to take an average of the equity beta because the equity beta is going to be driven by our capital structure. And we can prove this quite simply using some simple algebra. So let's do that right now. So in fact, the question I posted to you in this slide is, why is Dillard's equity beta so much higher than Sears? And the reason is because its leverage is basically more than 2 times its Sears value. Dillard's leverage is twice the amount of Sears. All right, so let's try to prove this quickly. So for simplicity, let's recall that our unlevered cost of capital looks like the following form. It's E over V times RE plus D over V RD. We can rewrite this as a function so that we write it as a function of RE. So that means that let's move all the terms to one side and have RE on the other side. So let's subtract both sides by D over V times RD. So that's RU minus D over V times RD. And let's multiply V over E on both sides so that we have RE on one side. So the V's cancel out. So what we get is RU D plus E over E. Remember that V is equal to so let me write this here. V is equal to D plus E. So we distribute the V over E, and we get D over E times RD equals to RE. And then we can cancel out this term here. So everything's written in terms of the debt to equity ratio. So then RU is therefore D over E plus 1 minus D over E times RD equals to E. And then we can group together this term and this term so that we get D over E RU minus RD plus RU equals to RE. All right, so what this tells us is that if RU is not dependent on the ratio, and also assume that RU is greater than RD, and so let me write that RU not dependent on D over E, then if we increase debt to equity, or the leverage, if we increase leverage of the firm, that's going to have an increase in RE. Okay? So there is a mechanical relationship between the cost of equity and leverage. And so simply taking an average of the equity beta is going to be a mistake because it's driven by the choice in capital structure. So in fact, what I just showed you is actually a proposition in the Modigliani-Miller theorem. So that's something you should check in the textbook. This is the fundamental theorem in corporate finance, but I'm just showing it to you here because I thought it would be an interesting segue to explain why comparing equity betas across firms within the same industry is going to give you, wide variation. Okay. So the question you should be asking yourself is, why do we have to assume that RU is not dependent on RE? This is not actually an assumption, and based on what we assumed in CAPM, this actually has to be true. And this is the first proposition in Modigliani-Miller. So let me actually quickly derive this for you, and I'm sure you will have more questions later, but I think it's important to see that capital structure for the valuation of the firm actually is irrelevant, meaning it doesn't matter whether or not you finance the firm through debt or equity. Based on the assumptions we made so far, having more debt or having more equity is not going to yield different values for the firm. So let me prove that to you in a few sentences here. It's actually quite simple if we're just using CAPM. So let me write MM here to indicate Modigliani-Miller. Actually, let me write out the name. M-O-D-I, Modigliani-Miller. This is from their 1958 paper. And this is the first proposition, which states that capital structure is irrelevant to the value of the firm. We can prove this through CAPM. So I'm going to write via CAPM, and also assuming that the debt beta is 0. So this is a simplifying assumption. Of course, it generalizes for non-zero beta, but to make the math look more straightforward, we're going to assume that beta D is equal to 0. So if that's the case, recall that our asset beta formula, or the Harris-Pringle equation, looks like the following when the debt beta is 0. So this is 0. And we can rearrange this expression and solve it for beta E. That's going to give us beta U 1 plus D over E. And we get this 1 over D over E, 1 plus D over E, because the V is equal to D plus E. So V equals D plus E, just to remind you how we get that. All right, so once we have beta E, we can then use CAPM to get the cost of equity, cost of capital of equity, using this term here. So CAPM tells us that the cost of capital of equity is equal to RF plus beta U, 1 plus D over E, and then our risk premium, right? The market risk premium minus the risk-free rate. So we have the cost of debt, and we also have the cost of debt is equal to the risk-free rate in this case, and we have the cost of equity, which is based on this formula here. So let's now compute the total cost of raising the capital. That's simply multiplying the amount we borrow and multiplying what we have to pay out. Okay, so D times RF is how much we have to pay out for the outstanding debt. And then E times RE is the amount we have to pay out for equity holders, right? RE. So the total cost of raising capital, has the following expression of D times RF. We didn't change that, but we now substitute RE into this equation. We have E times, let me just multiply it out. So we have E times RF plus D plus E times beta U times Rm minus Rf. Okay, and then we can factor out D plus E, right? And that will give us D plus E Rf plus beta U times Rn minus Rf. So what this equation tells us is that no matter how much we borrow from debt and how much we borrow from equity, our marginal cost is the same for borrowing debt or equity. In fact, the ratio of D over E doesn't appear in our expression. So whether you borrow debt, in which you pay out RF, or if you borrow equity, in which you pay RE, the ultimate marginal cost is the same. So if the cost is the same, then whether you finance in debt or equity doesn't matter. And so debt, equity, is, so capital structure, in other words, is irrelevant to the value of the firm. So conclusion, same cost, same marginal cost. Therefore, capital structure irrelevant. All right, so that's the proposition of Modigliani-Miller 1958. That's a key finding in corporate finance. We can go into it more if people have questions, but I'm presenting it here just to show you that once we establish capital structure irrelevance, we then have to conclude that there was a mechanical relationship between leverage and equity beta. And this is unrelated to, things like default risk, right? This is just mechanical based on what we know and what we assumed in this class. Okay? All right, so that's our example of looking at unlevered betas of comparables. And again, the point of explaining all this formula is to show you that if they're operating within the same industry, their unlevered beta is going to be the same. And just to emphasize, you should not look at the equity betas of individual firms within an industry because they can have wide variances. And this is driven by the fact they have different capital structure. And we have provided, based on the assumptions we made so far in this class, that relationship is clear, right? There's a mechanical relationship that's unrelated to risk. All right, so unlevered betas by industry, we can kind of see how the betas vary from industry to industry. So if you look at betas, say, from the early points, let's say below 1. So remember, beta of 1 means beta of 1 means that it moves 1-to-1 with the market. So we typically assume that betas below 1 are non-cyclical. So non-cyclical just means that the demand for these products and services produced by these industries doesn't follow the economy. In other words, the demand is not sensitive to wealth shocks to the overall economy. So I guess I can write that down. Demand does not depend on how well economy is doing, or to be more precise, not sensitive to wealth shocks or productivity shocks. So wealth and productivity are the same. Productivity just means that people are more efficient at producing things, so they're paid with real goods and services with less amount of work. But we're assuming that that's amounts to the same thing as wealth. Okay, so we're going to write wealth shocks. And everything above 1, we typically call these industries as cyclical, meaning that goods and services and the performance of these companies correlate strongly to wealth shocks or the performance of the overall economy. So it should be obvious, right? Because things like tobacco and pharmaceuticals, these are things that people typically demand regardless of how well the overall economy is doing. But things like footwear and advertising and cars, these typically move very strongly with how well the economy is doing. People have more income, people are more productive, they have more leisure time, and they spend their extra time, extra money on buying things, consuming things, and home furnishing is also something, right? Something consumable. And so these industries have betas above 1 because they're most likely very correlated with the overall economy. All right, so that's our discussion on unlevered beta. And if you don't have beta for a particular company, unlevered beta for a particular company you have at hand, the next best thing is to come up with comparables of firms within a particular industry, and sometimes computing a unlevered beta within the industry is a good starting point before you start filtering out firms that you don't think match the same cash flow risk level as the firm you're trying to value. All right, so as I already said, the most typical example in which you would have to compute betas from comparables is when you try to value a privately owned company. So I did provide an example for you in this week in an Excel sheet. So I'll let you go over this example on your own, and I will talk about this during our Zoom session. All right, so our final discussion is kind of just going over and emphasizing the flexibility of using CAPM along with our NPV calculation to calculate a proper discount rate for whatever you're trying to value. So it's obvious, I think it's quite obvious that of its flexibility when we're trying to evaluate a single firm, but we can actually go a little bit more granular than that. So if we think about firms with multiple firm divisions, we can definitely think about a reason why we would use this comparable method to come up with a proper discount rate for that particular division. So the example I present to you here is 3M. So I used 3M before. 3M is a conglomerate that makes things such as office supplies to also medical devices. So as I explained here, right, it has a healthcare industry, it has a computer display and graphic division, but it also has a consumer product division. And so when you try to come up with a proper discount value to evaluate the cash flow of each of these divisions, it would be wrong to use an overall beta for the firm to evaluate these divisions. What you should be doing is to try to match the riskiness of the division or cash flow with comparables that you can find that are being traded on the open market. In that case, you can come up with a more precise cost of equity and a cost of debt, and finally an overall asset beta for that particular division. So the answer to this question, these divisions clearly face different risks, so can we apply the same cost of capital to all of them? The answer is no. Theoretically, you should not. Again, the riskiness of a particular division is not the same riskiness of the overall firm. And so we're not risk matching properly, and what you should do is to find ways to match that risk to proper risk. And the way we do that is, again, we have to use comparables from a particular industry, as I just discussed before. Okay, so not only just for divisions, we can also think about project risks. So in the case in which we have a new product line, again, it would be a mistake to use a single cost of capital to evaluate the risk or to match the risk for a particular product line. That would be a mistake. And theoretically, each project should have its own individual cost of capital. And so, again, this is where comparables come in. If you can find a single company that's being publicly traded that produce very similar projects, then that firm definitely has probably has comparable risk to the project you're trying to take on, and that firm would serve as an ideal starting point to figure out what the proper discount rate should be. All right, and also acquisitions, a good example of this risk matching is thinking about acquisitions. So when you acquire something, you shouldn't be using the discount rate of the bidder cost of capital, right? If you're acquiring another company or a project, you should actually be using, if it's just a standalone evaluation, meaning this firm is operating independently, you should be using the discount rate of the firm before the takeover. If you're going to incorporate it into your overall company, you have to figure out some way to figure out the post-acquisition cost of capital. That would mean that you would need to tell me what the capital structure looks like at the firm after the acquisition and use that as a discount rate to evaluate this new company or even this segment or project. So let me emphasize this here. You should be using the target discount rate if standalone. Otherwise, combination. If there's synergies, for example. So I'll leave this to your professor in the advanced course to talk about this. But that's the idea. You need to think about what the firm would look like after the acquisition and use that as you come up with a discount rate to represent the new firm to discount rate the post-acquisition firm or the target that you're thinking about evaluating. Okay. I think I already restated this again before, so we can again adapt the comparable method to develop multi-division firms. And what this basically is saying that we can, rather than, if you don't want to value the firm in its entirety, you can cut and combine multiple segments to value these multiple segments together or separately using the comparables method. So long as you're able to match comparable firms to each segment and then somehow take a weighted average. This average can be, asset level based. So if you know the asset distribution across these multiple segments, you can weight your betas, essentially in that way, in that fashion, right? All right, so to summarize, CAPM and capital budgeting, which is the main topic of this lecture. We talked about the advantages of CAPM. So CAPM is very practical, it's very easy to implement, and it's robust in the sense that there are a lot of moving parts that allows you to make, broad assumptions or very specific assumptions to come up with different cost of capital. It's disciplined because you can back up your assumptions. So long as you can back up your assumptions, you can rationalize your cost of capital. The CAPM is very simple because all you really need to do is to figure out how to project your risk, and we can then incorporate systematic risk through the CAPM equation. So some empirics here I gave you before we conclude this lecture is Graham and Harvey in 2001 conducted a survey of CFOs for all Fortune 500 companies, and he found that for the most part, people always use MPV for capital budgeting purposes, and they use CAPM. Most of them, at least 3/4 of them, use CAPM to come up with a discount rate. But there is something that's problematic here because it seems like almost 40%, only 40% of the people use multiple discount rates to discount projects, but most of them actually only use a single company-wide discount rate. So that just means that they're not following the advice of, these corporate finance researchers. But in fact, what they should do is they should do their best to risk match a project or division to the proper discount rate. So they need to make adjustments to their single company-wide discount rate to reflect the different risk of their division or project. Okay, so that's what we covered today. We covered how to derive the cost of capital of debt and equity, and then found ways to combine them into a single discount rate. And we also talked about their comparable methods, which means that if we don't observe asset prices, stock prices, or debt prices, next best alternative is to come up with a set of comparables to derive these measures. Okay, and we take a simple average to come up with the cost of capital. So next week we will deviate a little bit into more asset pricing topics, and so we'll talk about market efficiency and index investing, and also extending the CAPM model to other factors. But so by the end of this lecture, you should have enough information and theory to actually finish your project for this course, your final project for this course. All right, so that's it for today. If you have any additional questions, feel free to leave a comment or send me an email. That's it for today, and have a nice day.